So how do you manage assets more efficiently? What you're looking at is what happened to our average weighted client portfolio, what we would call a core portfolio last year in the calendar year 2018. What's in red were assets that lost money, and collectively, they dragged down the return of the entire portfolio by 2.3%. What's in green were assets that rose in value. They brought the portfolio up 4.6%. So the weighted return was not great, it was 2.3%, but the Morningstar neutral balance portfolio was minus 4.7%. So there was a gap of 7% in the returns for a 12-month period of time. But notwithstanding that, in order for this model to work, you've got to do the following. You've got to sell the green and buy the red. That's what rebalancing means. So that's what we do. And essentially that rebalancing, obviously interestingly, as we've watched what happened to markets in the first 3 months of this year, as it's turned out, has been the right thing to do. So the question you have to ask yourself is this: are you Spock or are you Homer when it comes to the way you invest money? So I thought about this. I managed to dig up some old photos of Star Trek, and of course there's Spock, and then there's Bones, or Dr. McCoy, who never got along. But I want you to just suspend your imagination just for a second and think. Just imagine Spock, it's a long trip, they've been on the Enterprise a long time, he's bored, so he decides he's going to study to get a chartered financial planning designation. It takes him, whatever, an hour and a half. And he's a designated financial planner, and he's going to look after all the investments for all of the officers of the Star Trek Enterprise, including Dr. McCoy. So as McCoy walks in for his meeting, the first thing he says is, "Damn it, Spock, I'm a doctor, not an investor." And my apologies to anybody here who's a physician, okay? And I want you to imagine Spock just being very calm. He's playing chess here, three-dimensional chess. He's saying, you know, Dr. McCoy, we lost money in stocks last year, in bonds, high-yield bonds, preferred shares. I think what we're going to do is sell all of those things that we've made money at, and we're going to buy more of those things. You can imagine McCoy's response. Are you out of your Vulcan mind? It's just that's what we would do, right? So behaving well requires the following thing. You have to know yourself, which means you have to avoid overconfidence. You have to embrace uncertainty. A Minsky moment refers to Hyman Minsky, great economist, who said the longer something rises or even stays stable, the closer we are to some kind of cataclysmic result. It's a bit like thinking of how avalanches work. We have to play the odds, which means we have to avoid loss aversion. We have to be diversified in our asset classes, and we have to accept pain. It's not possible to invest without going through periods of loss, at least within certain parts of a portfolio. We can just diminish the risk of it occurring. So let's look at déjà vu. Let's bring this all together in terms of where to from here. We've been here before, and we're going to be here again in the future as well.